Welcome to the High Rise Podcast, presented by Headset, the leading data and analytics company for the cannabis industry.
Welcome back to the High Rise, a laid-back, data-backed conversation, all things cannabis. And today we have a very special guest, longtime friend of the show, just about in the five-timer guest club, Matt McGinley, Managing Director of Needham. Thanks for joining.
Thanks for having me.
Yeah, really excited to cover Q2. I think there's tons to talk about, even beyond just the company highlights. And why don't we start with just like the key themes that kind of happened? You know, last week, Emily and I were talking a lot about some of the macro headwinds, some of the legacy market growth rates. We published a report over here at Headset, and you know, some states just are struggling a bit. And I know some of these companies that we're going to talk to certainly had some exposure in some of those markets. So what do you think, Matt, when you think about kind of industry themes for Q2 and you know, how it might have varied from, you know, this time last year or even previous quarters?
I think the biggest change is overall the growth was a little bit better this quarter. In the fourth quarter of 2021 and in the first quarter of this year, revenue declined about 1% quarter over quarter. In this quarter, we estimate industry revenue grew around 7%. Part of that was just the rising tide that lifted all ships with seasonality, and part of that was market specific, but we did have better seasonal trends. So COVID and some of the weather headwinds that we had in the first quarter dissipated. And cannabis purchases do seem to have some degree of seasonality that's similar to what we see in alcohol, where people purchase and consume less based on the time of year. And typically it's, you know, it's similar to what you see in alcohol. Like people will have, you know, great New Year's or whatever, and then they won't drink it. You know, they'll have their New Year resolutions, and demand tends to drop off in January, February. It will typically inflect in March. We did see that fairly substantial inflection in March this year. Again, so that just, you know, overall into the second quarter, you know, provided for some better growth rates. We also had adult use conversion in a few states. We had Montana, New Mexico, and New Jersey all started adult sales. The overall revenue is still kind of small for those at present, but you know, that'll continue to build, but that was additive. And then, you know, patient counts are generally growing in most medical markets. That occurred again in the second quarter, although we are seeing a little bit of slowdown in the rate of patient growth in a number of states. Well, it's not completely true in every adult use market, but we did see just better unit growth trends in most markets like Massachusetts, Pennsylvania, Michigan, Illinois. The unit growth was just better in the second quarter than it was in the first. And that kind of ties into the things I said before on what those drivers would have been. But the flip side of that would have been there was unit decline and revenue growth in some markets. That was mostly in the West. Some markets like Oregon, Washington, Colorado, Arizona, Nevada, I mean, all of them have had revenue that was down, and in some of those markets, the volumes actually declined. And a substantial headwind that we're going to have going forward is still the macro situation is pretty uncertain. And what's occurring is that inflation is reducing disposable income, and that's outpacing wage growth. So even if there are some indications that the rate of inflation is slowing, so it's like second derivative negative at this point, the economy is still slowing. And as that occurs, we'll see more job losses, which could further pressure consumer spending. And that is particularly troublesome for this industry because remember, this is like an all cash industry, at least at retail. And you know, if cost of living is growing at a faster pace than income, someone can use a credit card at a grocery store to defer that payment because they want to get something to eat until they can get, you know, cash from paycheck or whatever. But because the vast majority of transactions in this industry are done in cash, if someone has less cash to pay for food and gas, those prices have gone up, then they might not have the cash to make a purchase at the dispensary. And on top of that, the illicit category remains resilient. And given pricing is almost, you know, always going to be cheaper to go through the illicit category than it will be to buy it from a legal dispensary, there's likely some trading down that is occurring during that time period as well. And I think we're seeing that play out in traffic versus ticket. The number of transactions is generally increasing. So, you know, customers are visiting dispensaries more often, but their basket size is smaller. So they're buying fewer items. Price is probably a little component of that too, where price is also going down. But you know, that's the type of behavior that you see generally when consumer spending is under pressure. And we definitely heard that from most of the operators this quarter about some of those macro pressures. And then on top of that, and I mentioned it a little bit before, but you know, we are seeing price decline across most markets. That's, you know, par for the course, that's common, but you know, that we're seeing higher levels of wholesale decline where those declines are most acute out west. But you know, even in states like Michigan and Massachusetts, as the supply demand balances have gotten a little bit more balanced, I guess, you know, we've seen prices come down, and that's, you know, just an overall trend that we see in a lot of markets. But overall, I think when we entered this year, we thought we'd probably see growth in the industry that would be, I think last year was 30% growth rate year over year from 2020 to 2021. We thought would probably be at like 13 to 15% when we entered the year. And it'll probably be like 7 to 8% right now, just based on all these kind of factors and how they're playing out. Now in 2023, that growth rate probably looks a little bit better and probably gets back up to a double-digit rate, to maybe low teens again, because we'll have New York and Connecticut and Rhode Island and the full benefits from New Jersey. There's certainly risk around price compression, and it's not a given that these Western markets will be flat or even up next year. But just based on some of the changes with market structure and more states coming online, we'll probably see better growth rates into next year.
Do you think it's a bit of a combination of these broader macro trends as far as like consumer purchase power right now maybe going down, combined with just challenges in the industry, the stuff that just hasn't been sorted out? I mean, the illicit market obviously has been something has been an age-old problem. But, as far as like growth expectations, you mentioned, New Jersey, new markets coming online, still a bit smaller. Are those things a bit behind where we thought they would be? Or is this just like the broader trend right now? Like, hey, people are having a harder time. There's this inflation pressure. Maybe we can't spend as much on cannabis, just like we can't spend as much on a big screen TV.
Yeah. Things will always take longer and be harder to do in the cannabis industry than probably in any other industry. But yeah, so I mean, some of that is absolutely driven by market factors with states not coming online or not ramping at the pace assumed, but that's more of a timing issue. The more, I guess, near-term theme, I would say probably over the past like 3 quarters, as the economic situation has deteriorated and as inflation has remained persistently high. I think some of those other factors that are now beginning to impact consumer spending are now manifesting themselves and kind of showing themselves more in a bigger way in terms of when the companies report.
Yeah, no, that makes sense. And I've definitely heard like credit card debt is going up for a lot of consumers as they maybe try to live the same way, but things are getting more and more expensive. So hopefully they're using the credit cards on other items so they can save the cash for the cannabis industry. Well, shall we dive into the company highlights?
So I'll go for a couple of key themes.
Sure.
And when I reference these things, the benchmark that I'm talking about here is when I'm quoting these numbers for the group, I'm referring to the 10 largest MSOs or the 10 largest US operators. So it's a reflective sample of sort of what is going on with the public operators, but broadly the trends we see here are the same as the industry. But I'm not talking about Canadian LPs, or I'm not talking about ancillary companies. It's these that are the benchmark that I'm referring to. But overall revenue this quarter grew 6%, and that was after being down 2% in the first quarter. Thematically, I would say if a company had exposure to New Jersey, you were generally better than that. And if you didn't have New Jersey, you're worse than that 6%. New Jersey is just one piece of the 40 states or so that have regulated cannabis programs, but New Jersey is not the only show in town, but it's a meaningful contributor to growth for the companies that actually have exposure to that, and it will be again into 2023. To kind of highlight that disconnect of having New Jersey exposure and not having New Jersey exposure, Curaleaf, Verano, and Ascend all have New Jersey exposure. Curaleaf was up 8% in terms of revenue this quarter compared to the average of 6%. Verano was up 11%, and Ascend was up 15%. But Cresco and Trulieve, which don't have New Jersey exposure, they were only up 2% for Cresco and 1% for Trulieve. Cresco and Trulieve both did better than the first quarter, but that sort of inflection that they saw from the first to the second was just lower, just based on where they have their footprint. The second trend I'll talk about is retail versus wholesale growth. All of the growth that we saw this quarter was from retail sales through dispensaries. Wholesale revenue, which is mostly the sale of branded cannabis products and a little bit of bulk wholesale, but mostly sale of branded cannabis products, that generally declined. As a percentage of total revenue, the retail portion has continued to grow for the past really year or so. And for the group, that's now an average around 76% of the revenue comes from retail, and only 24% comes from this wholesale business. In this quarter, the average retail revenue was up 9%, and the average wholesale revenue declined by 5%. So there's a pretty big difference in terms of how the retail assets are performing versus the wholesale assets. Clearly see different impacts from New Jersey in both the retail and the wholesale channels as well. So Curaleaf, for example, their overall retail revenue was up 11%, but they have a very big wholesale business in New Jersey. I think they're very likely the biggest. They were only down 2% in their wholesale program. But Green Thumb, which had retail revenue that was very close to Green Thumb's, they were up 12%. They have a much smaller wholesale program in New Jersey, and they had headwinds in Pennsylvania and Massachusetts and Nevada that pushed their wholesale revenue down by 12%. So, similar top line growth rates, but, not every wholesale program, or I should say having a bigger exposure, for example, for Curaleaf to New Jersey really didn't change, I guess, the direction of the wholesale sales that they had, but it certainly helped it, at least relative to what a company like GTI would report. And then a company like Trulieve, which had no exposure to New Jersey at all, had retail sales that were up 3%, but their wholesale revenue dropped 22%. Now, they don't have a big wholesale business overall, and that was mostly Pennsylvania, but it just kind of shows the overall trend. Like if you don't have exposure to some of these markets like New Jersey, it can really, alter the growth rates. And I think within that wholesale retail split, I think there's two key things to think about for the long term here. The first is that the vast majority of this CapEx that's being spent today is going towards building these larger cultivation facilities with the intention of becoming this big branded manufacturer where they sell to all the other dispensaries in the state. But as they establish these facilities, in many instances, they're already selling into a saturated market, and it's often hard to get that retail distribution. So it's not a given that you build a facility and you're going to be able to sell and get slotting or shelf space at a dispensary. And when they can't sell their own product to their own dispensaries, the best option is to sell it through their own stores. And where we see this is we see a surge in the amount of intercompany eliminations that these companies report. So they're basically a portion of their inventory that they would have sold through other retailers, they're now selling through their own stores. And if they're selling it through their own stores, then they just need to get less from other manufacturers, which means that there's a less robust wholesale market. And on the margin, that limits brand availability for consumers. So that's not necessarily a good thing for them. But for the vertically integrated operators, this is a very high margin sale, selling a product that you produce through your own, you grow and then extract and produce and then sell through your own stores is the highest margin sale that these operators will have. That's helping them. And if you look at like how this is playing out in some of these different markets, I would say 2 years ago in a state like Pennsylvania, like Cresco, Green Thumb, and TerrAscend were the big wholesale businesses in the state because they were the early movers there. Well, today there are many more producers with operational facilities. And Curaleaf is now bigger, Trulieve is bigger, Columbia Care is there, Verano is there, Air is there. And because there's so much more supply coming online, the pricing is falling. But many of these newer additions to the party are just having a hard time getting shelf space, and then they're selling it through their own stores. But even if they do get additional shelf space, basically the established operators like the Crescos, the Green Thumbs, the TerrAscends are losing some of those sales because they would have previously sold it to Trulieve, but now Trulieve has their own product that they'll produce in a state like Pennsylvania. So I think that the two key takeaways on that first point is that there is that surge in intercompany sales that we're seeing is partially a product of having more available supply internally, but in some instances, it's because they can't sell it elsewhere. The second takeaway is that we're now seeing rational behavior around capital investment because of this dynamic where the operators are generally scaling back the size of some facilities to reflect that dynamic. They're saying, maybe I don't need a 150,000 square foot facility, but I can do this with 75 and then expand the pad or expand this in the future if the market structure or the competitive structure of the market changes over time. The second thing that's, I think, important with kind of this retail wholesale dynamic that's playing out is that the retail growth is generally finite because most states have caps on the number of dispensaries that can be owned. And when you're looking at the bigger MSOs, they're generally near the caps in most states. And for a lot of operators, you look at where the unit growth is coming from. It's generally not from Illinois where they're capped at 10 and most of them have 10. It's not from Massachusetts where you're capped at 3 and most of them have 3, or even PA at this point. It's coming from states like Florida or West Virginia where those unit volumes are just significantly lower than what you would see in some of these other states. And that's important because if that retail growth here is finite or it comes from states with lower volume growth, we will see average unit productivity declines as those new units come online. And the other thing is if the wholesale businesses aren't growing and the retail growth is generally, like I said, finite because of the caps, then you need new market development or new markets to keep that growth going. And if that doesn't occur, then the growth trajectory for these businesses, will look worse.
Yeah, really fascinating stuff. There's a whole lot to unpack there. And one of the companies that I know, you don't cover, but is publicly traded out in California, the parent company, I noticed in their earnings, like their wholesale versus retail percentage of revenue just really dropped off like pretty significantly. I think it went from, what is it? It's looks like their percentage of revenue coming from retail is 70% and wholesale 30%, and that's versus 80% wholesale previously, which is just wild to see. And that's, in California. So this is happening everywhere. And there's a lot of interesting things here. But one, it's like when I think about the wholesale market, and I think about, these brands that, the MSOs are developing and distributing out to other retailers, it makes me feel like there's not a lot of brand power here, because if there was a lot of brand power in these brands in the market, you'd think the consumers would be demanding, hey, I come into the store and I don't see my products here. I don't see these brands here. Where are they, right? Why aren't they here like they normally are? Assuming that they're losing, shelf space completely for some of these brands. Maybe it's just volume is much lower and the retailers are pushing towards their own house brand basically, and they still have the shelf space, but maybe they're losing the shelf space, to make room for, their own vertically integrated products. And I just feel like with some brand power, you'd have consumers asking, like, where are these brands, and continuing to drive that wholesale business. So maybe there isn't a whole lot of brand power in these markets at this point.
I mean, I just think they're so limited. There's so few doors available in these markets that if you're at the door and you're shopping, you're going to take what's there almost and keep going. And I think the operators are getting smarter about the tiers of brands they're offering through their own vertical, but it is, you're right, Sai, like the retailers, I think, still substantially hold the power. And I know they've done partnerships with some of the California brands to try to bring some of these stronger brands to the East Coast. I mean, Cookies is a perfect example of that with TerraSend, or I know a lot of them have relationships with Kiva, but I just think that the consumer, my observation, and I'm curious, Matt, if you feel differently, but my observation is that and this was true actually in Chicago too, is you get in the door, that's what they're offering, and you're kind of a captive audience. So I know a lot of the operators talk a lot about brands, but you know how I feel. We have a long way to go in terms of really developing brand as it exists in the broader consumer sector.
And it does feel like a bit of a vicious cycle. Like to your point, Matt, if they can't distribute this stuff wholesale and they've got to sell it internally at their own stores, then that doesn't leave much room to take on other products from other wholesalers, right? And it just keeps kind of spiraling down until eventually it's, primarily, their own vertically integrated products. And of course, you're right, they're incentivized. The margins are much better, in those products. They know how to speak to those products really well, right? Because they're all part of that organization. So do you think that this is just going to continue to accelerate? Like, how does it get out of this kind of downward trend on wholesale?
Well, less capacity addition would certainly help that. But, in states where it is a more consolidated production and consolidated retail base, this will be an issue. Like there will be operators that have more production capacity and they will just be selling more of it through their own stores. And that does risk the existing wholesale programs of operators that have, those established programs. So I don't know if it necessarily gets worse, but it probably won't get better into the back half, given that, more of this capacity addition is coming online. But, at a certain point, the capacity addition sort of stops for many of these operators. And then that will sort itself out with who's the best product and where the consumers want to go. So ultimately, if they sell too much of the product that's their own and it's not what the consumer wants, then that helps them in the margins over the short term. But over the long term, if you lose that customer for good because they want that other brand that's carried somewhere else, then it's a lot more expensive to lose that long-term, sale than it is to, make up a little bit of margin or, save some potential inventory impairments or something over the near term.
I think this also highlights the operational complexity of these businesses, where you have so many aspects of it that you have to get good at. And the good news to me is that there's a lot of upside to unlock, just operationally speaking, in terms of how these businesses are running. Wholesale B2B sales is a whole different strategy than what you do in the four walls of your retail environment versus even your brand strategy. And one of the operators told me, they joke because they know they have so far to go, but they kind of call each of these new states as they turn them on, kind of to what Matt was talking about the supply from Curaleaf, is OPEC for dummies and they're trying to just make sure they can get products across the different doors. They can get brand presence across the different doors. And they do tend to work well together in these early days, and then it gets more competitive. But I thought that was a really funny thing to hear. And also it does represent what I understand to be true of the challenges around wholesaling, just even from an operational excellence standpoint, aside from market dynamics. So there's a lot of upside to capture if they can dial it in, but it's going to get harder and harder.
And you called out Curaleaf and their exposure to New Jersey as a driver of less wholesale decline. Is that because it's a new market? And to your point, Emily, like it's as early days in a new market and everyone's playing pretty nicely, but then, fast forward a year from now, will it look very different? Or it's just the dynamic of New Jersey and the way it's built out?
They were a big medical operator in the state, and they have a operational production facility, and they built up inventory ahead of it. That was not an opportunity that was afforded to a lot of the operators, or they just weren't ready in time for that to go. And so Curaleaf is a bigger part of the overall market right now, just based on them being ready for that market conversion. Now, will they sustain that? Or there must be a much more capacity coming online in New Jersey. By definition, if that market is going to grow, they need a lot more than just Curaleaf and a couple of the operators right now. But more of that will come online. And so, I'm sure they have, I have no clue what market share they have right now, but I'm sure it's outstanding. I'm sure that will slip. But, whenever you establish yourself early in the market, you probably do build up some, brand loyalty and things like that. So I would think that would probably have some long-term benefit. But, this is a category where there is a high degree of switching, and, variety is important. So it's not like, just because Curaleaf was there early, it means that they're going to own the market for the next 20 years.
Yeah. They do have a lot of that kind of CPG DNA a bit, with like being able to launch a product in like multiple markets at the same time. I think they still hold the record of, launching a new product in as many simultaneous markets as possible, just because of their footprint, and brands like Select that have, been in markets like California for a long time. So they're kind of geared up for it, I feel like, and every organization's different, and some are licensing and bringing it over, but it seems like they've got some of that ability. But we'll see how well it holds. I think it's going to be interesting. Like, just try and remember, as New Jersey develops, like, are they able to hold that market share? Are they able to build consumer loyalty early on because of their position? Or is it, just a matter of there's just not a lot of stuff available quite yet? But that'll be an interesting narrative to kind of watch as it unfolds. So shall we dive into some of the company highlights?
Why don't we just make two more quick points on margins and cash flow, just because you don't have to say it for all the companies, but margins are a good indicator of operating efficiency. They can be vastly different based on the footprint and the level of vertical integration and assets under development and so on. But the biggest long-term dynamic at play here is that these companies are generally selling a deflationary product that today is in an inflationary environment. And I hope that we're not running at 8 or 9% inflation a year from now, but I can guarantee you'll still be talking about price deflation next year. But operators are generally selling the same unit for less money, and the inputs to make it in terms of labor cost and packaging and electricity has gone up. And because of that dynamic, operators need to be extremely focused on efficiency gains, and the status quo is never going to be okay. The existing asset base always needs to be reviewed and tweaked to reflect the market and asset productivity. And that needs to happen all the time with these different operators. Now, over the near term, that's the biggest long-term dynamic is ongoing efficiencies to offset price decline. But the biggest near-term dynamic for margins is top-line growth. And when we had soft trends in the fourth quarter and the first quarter, the margins were generally dropping, and they did drop for the group. And in this quarter, with the higher rate of revenue growth, margins on average moved up. So gross margins were, I think, around 53% in the middle of last year, and they slipped 280 basis points in the fourth quarter, and then another 175 basis points in the first quarter. And this quarter, on that top line growth, they improved by about a point back to 50. So they're not where they were at the middle of last year, but they did improve on the top line growth that we saw in this quarter. And those EBITDA margins, like I said, they improved in the quarter. There were a few that did have margins that were down that were probably more company specific, like Verano and Columbia Care. But EBITDA margins were, like I said, flat or up for most of the other operators, with the average being up a little bit more than a point. The other point I make on margins here is that scale really matters, and EBITDA margins have come down by about 5 points since mid 21. Now, some of that's M&A related, like Trulieve bought a lower margin business, so their margins came down. TerraSend acquired no margin Michigan business that lowered their margin profile. So there's a lot of nuances here, but the bigger operators generally have higher margins. So Curaleaf, GTI, Verano, Curaleaf all have EBITDA margins over 30%. The next five that are less scaled, like Columbia Care, TerraSend, Air, Ascend, and Jushi, they're running at an average of like 13. Now, when you're running at lower margins like that, it's difficult to hurdle 280E, which makes it harder to generate cash flow. So margin rate and operating efficiency are extremely important, because without reasonably high gross margins and pretty tight control over your expenses, it just becomes very difficult to generate cash flow. So margin rate improvement is key, or efficiency gains to offset, price declines are key to get those margins and the ability to generate cash flow up. And then maybe to segue that on the cash flow point there, the cash flow this quarter obviously didn't look so great because a number of companies delay or defer making tax payments because the penalty is less than the cost of alternative financing. And as a cash management strategy, that makes total sense. But those payments are due in April for last year. And even if you were paying on time, as a number of them do, the IRS quarterly tax schedule requires that they make a payment on June 15th as well. So if a company didn't pay taxes all year and just paid in April, they would have had one big tax payment. But even if a company did pay on time, they still would have had two tax payments in the quarter. So this just will, even if you pay on time, your cash payments would have looked a little bit worse, or that would be a headwind to cash flow in the quarter, just the way that the tax schedule works. So the cash flow this quarter, despite the margin improvement, looked weak based on those tax payments. But when you begin to tease out the noise with taxes, with the profitability moving up, with growth in working capital from things like inventory build is generally waning, and CapEx is generally on the way down. So that aligns with better cash flow overall into the back half, and that is critical for all these companies.
Great. So we'll look for more improvements there the year goes on.
Yep.
Okay.
So we roll into talk Green Thumb?
Yeah, let's do it.
Great. All right. So Green Thumb, the revenue this quarter grew 5%. That was a little bit better than expected. And that was after revenue was flattish in the first quarter. Their retail revenue was up 12% quarter over quarter. And they only opened up one dispensary in the quarter, and that was in Minnesota, which would be a pretty low volume dispensary. And they would have had some modest benefit from the dispensary that they've had from Illinois, but the majority of that growth would have come from the two dispensaries they had in New Jersey that converted to adult use. I think they noted that Illinois retail revenue was also up on the quarter relative to last quarter, but New Jersey drove the majority of that retail growth for them. Now, the offset to that, as I noted before, was that wholesale revenue, or their CPG business, was down 12%. That segment had been kind of piddling along with flattish revenue for more than a year, despite substantial production capacity additions in a number of states. In this quarter, they actually had a decent drop in their wholesale volume. It was over $8 million. That was mostly Pennsylvania and Massachusetts price compression, but I'm sure that Nevada and Maryland probably didn't help that either. And as I mentioned before, as more operators come online in Pennsylvania, that becomes a greater pressure there. But unit volume through their wholesale business is also likely dropping in some of these states like Massachusetts and Pennsylvania, just given that there's more supply in the space. Now, into the third quarter for them, they're not going to have much of a change in the number of dispensaries, but they'll have a full quarter benefit from New Jersey dispensaries under adult use, and they'll also have facilities in a couple of states that'll be complete that could add to that wholesale business. But New Jersey, for GTI, they don't have a very big wholesale business yet in that state. So retail, I would think in the back half would likely remain the majority of the growth, and I don't think we'll see a ton of growth out of them for wholesale into the back half of the year. From a margin recovery standpoint, or I should say from a margin standpoint, GTI actually had a pretty good quarter, and they recovered a lot of what happened in the first quarter. And I won't fully rehash the first quarter, but basically GTI had flat sequential top line last quarter, and they just took it on the chin in terms of the soft volumes, their overall soft volume growth, which led to operating deleverage on their fixed cost. And they were hit fairly hard in terms of inflation in both wages and COGS. So in the first quarter, flat revenue resulted in margins that were down on an EBITDA basis, that were down about 350 basis points. And that was probably more heavily weighted to inflation, but there was also, pricing related issues there. In this quarter, they did change some of the way they allocated expenses. And so there's some moving pieces that you had to work through to kind of figure out what actually happened quarter to quarter. But on a like for like basis, their gross margin rate improved by about 250 basis points, and they levered their core G&A by about 50 bips. And so their EBITDA rate bounced back by about 330 basis points to 31, which is a pretty good recovery. Now I'll make, I guess, 2 points on that. The first is that was a good quarter where they recovered almost all the margin that they lost in the first quarter. That shows if you're efficient and you have these single state catalysts like New Jersey, which is going to be higher margin, that can offset pricing pressure or headwinds in other states. So that's a very good thing. And the second point is maybe not so good, and that's that GTI will probably grow its top line by about 15% year over year, or by about $140 million this year. I mean, last year they ran an adjusted EBITDA rate of 34.5, and this year it'll probably be a little bit over 30. But that 4-point drop in margin rate will basically keep the EBITDA dollars flat year over year. So 15% top line growth is what it is. It's good, but flat EBITDA is not great. And while a 30% EBITDA margin rate is pretty fantastic for most businesses, that's good for an MSO, and that's good for most companies in the consumer space. But the reason I flag that is because as margin rates compress in this space over time, and they will very likely come down over time, investors need to think through how these companies will look over the long term. And it isn't all about just top line growth. These cannabis companies need to build very efficient operations that can offset the margin drag that's likely to come, because, as I said before, lower margin rates will equate to less profit because it makes it harder to hurdle 280E, and it means you have less cash flow generation.
I mean, we'll get into the other companies here that you cover, but do you find that that's kind of unique to GTI, or are you seeing that across the board, given some of these inflationary pressures, pushing in the price pressures on margins? Is that like a common theme through these companies, or kind of stands
absolutely,
out? Yeah. Okay.
Yeah. And this, like I said before, like this quarter kind of broke that trend of down margins because they had better top line growth. So if you have better top line growth, obviously your margins will be in a better shape. But yeah, that's not the things that they face were not unique to Green Thumb.
Yeah. Makes sense.
And then maybe one last on GTI, like I won't work through the cash flow, but the balance sheet is basically in pretty good shape. They don't really have any material maturities to 2025. Their gross capex this year will probably be about $200 million, probably about $150 on a net basis. So their capex is really beginning to wane here into the back half, and most of their projects will really be completed by the end of 2023. So Green Thumb has been fairly consistent with generating good cash flow, and they did generate, I think it was $40 million of operating cash flow in the first half of this year. That was down from the back half of last year and down from the first half of 2021. It's a little lower than prior periods, but a lot of that was related to inventory. But overall, the cash generation with these tax payments for them being largely done will look a lot better in the back half.
Great. Should we move on from Green Thumb?
Yep.
All right. Who's next on the list?
This is Curaleaf. Yep. So Curaleaf revenue overall up 7%, retail up 11%, but wholesale declined 2% to 25% of sales. On the retail side, I think the story here is mostly New Jersey as well. They had that Belmar store opened up on April 21st, and they had that Edgewater Park store that opened up later in the quarter. But they also had a pretty good quarter in Florida where they grew unit volume pretty nicely, and it looks like they gained some share. In the CPG business, similar story to GTI. Wholesale was down, although not as much, but they did certainly feel some pressure there. The big headwind for Curaleaf was on unit decline in California and Colorado as they rationalized unprofitable accounts. So basically they were selling at a loss. That's a short-term strategy that can be fixed with volume sometimes, but if you don't have the volume, you're just selling at a loss and you're not making it up with volume, but just selling it at a greater loss. So they made some decisions there and are culling some of the way they're distributing product in some of those states. But I would think that Curaleaf probably had similar pricing headwinds and issues akin to what GTI had in Pennsylvania and Massachusetts. From a margin standpoint, Curaleaf had a nice improvement in gross margin rate. That was, again, likely helped quite a bit by New Jersey and Florida, but they're also selling more product through their own stores, as we mentioned before, and their gross margin rate improved by about 265 basis points to 52%. Now, the gains there were partially offset by core G&A growth that was driven by headcount addition. That hurt rate a little bit there, but EBITDA came in a lot better than expected on a rate and dollar basis because of those gross margin gains. The EBITDA dollars sequentially grew 18%, which is quite good, and the rate there improved by 225 basis points to 25%. I would say that Curaleaf used to be solidly and consistently below average in terms of margin rates, and they're now clawing their way back to average here. So that's a good thing. And hopefully the gains that they made this quarter in terms of margin rate are an indication of a continued focus on efficiency that will result in future margin gains. So hopefully this is the start of a trend, but I would say that broadly we are seeing improvement in efficiency with Curaleaf. Now, from a cash flow standpoint, Curaleaf does use this deferred tax payment strategy, and they did make very big cash payments in the second quarter, but they still generated positive operating cash flow in the first half of the year. Similar to GTI with working capital investment now waning, and they dropped their CapEx plan a little bit for the back half. The cash flow should look, I think pretty good there in the back half as well. Curaleaf did provide full year guidance at the beginning of the year. They gave a range out of 1.4 to 1.5 billion. They think that they will be at the lower end of that range, and they think that the third quarter sales will be flat to low single digit positive. That's probably a lot of Florida and New Jersey with some offsets in wholesale. And that means they probably won't have anywhere close to that margin expansion like they saw in the second quarter. But if the third quarter is flat to up a little bit, that would imply that the revenue in the fourth quarter would be up at, probably a low teens to low 20% range. Probably about 6 to 7 points of that growth will come from Trike, which is likely to close here in the coming months, which is the acquisition. It's mainly Nevada with a little bit of Arizona in it. They'll also add another dispensary in New Jersey in the fourth quarter that'll be adult use, and that will also be additive to the revenue. And they did a 24.5% EBITDA margin in the first half of the year. They think they can get to 28% for the full year. And like I said, I'm encouraged by that renewed focus on margins and the gains they made in the second quarter. But I think they might fall a little bit short of the 28 for the year, but I hope they prove me wrong. And then the last point here I make is that they have these, I can't remember what they call them. They call them either investment markets or development markets, but it's basically states like Colorado and California and Oregon and Michigan. And they also lump their international business in there. That was a 5-point headwind to their overall margin rate. So if they didn't have those markets, they would be around 5 points lower, but that was consistent quarter over quarter, which shows that these other states where they're now driving the margins higher, like Colorado and California, where they're eliminating unprofitable parts of their business, is now being negated by probably some of the growth that they're doing in international. So that headwind from these investment markets or development markets was about the same quarter over quarter, which you want to see improvement, but it's flat, but it's shifting, I think, some of the spend there and some of the headwind.
Yeah, I know Boris is really dedicated to investing into these more frontier opportunities. He always has been. And it's just interesting to watch how it's unfolding. They're transitioning to GAAP financials, right? He had mentioned they wouldn't be because of their exposure abroad, but I think that they said this time around they are going to transition to GAAP.
Yeah, I believe the plan is to convert over in 2023. I'm not sure if they'll do the final 10K from this year in GAAP or they'll do it in the first quarter, but I know that they have a plan coming up here in the next handful of quarters to convert over.
Curaleaf, the standout on the wholesale, had the smallest drop on wholesale out of all the companies that you're looking at.
There were a couple that actually had wholesale growth, but they were much smaller businesses. But yeah, I mean, they did pretty well. Yeah. So would we say the average was down 5% and they were down 2%? So they did better than average.
Better than average.
Outperform.
But I would not say down 2 is a you want that to be up.
Yeah. Outperforming by down less. Okay. Let's move on to the other Florida behemoth. Yeah.
Trulieve. Yeah. So Trulieve, I think the punchline here is that the quarter was kind of in line. I mean, there were a few puts and takes. We'll walk through here. There was a lot of movement, but not a whole lot of change. They did change some of their guidance, but I mean, their operating performance, basically revenue grew a little under 1%. That was all retail. I think retail was up 3% on unit growth. And then they had, bounce back and recovery of productivity from the soft start to the year. Probably around 60% of revenue right now for Trulieve comes from Florida. And Trulieve does have a pretty small wholesale business compared to other MSOs that average around like a quarter revenue comes from wholesale versus Trulieve's, which I think is only around 7%. But like I said before, it was down 22%. Their biggest wholesale market's Pennsylvania. That was likely the majority of the decline, but they also had a combination of price compression and unit decline in Arizona and Massachusetts, where they have smaller wholesale programs. I think they said their traffic was up 6%, their basket was down 3%. So that they highlighted that thing we discussed before with how the consumer spending is changing with more frequent purchases, but smaller basket sizes. And their adjusted gross margin went down by about a point. They have some new facilities that are partially operational, but they still have a 50% gross margin rate, which I think is pretty good. And they're probably in the mid to high 60s in Florida, and everywhere else is probably like mid 40s. So they've certainly some work to do in other states. And what they want to do is maintain in Florida. G&A for them had a ton of noise in it because they have these earnouts and expenses related to discontinued ops. But the core G&A dropped by around $4 million, and that improved by about 120 basis points in terms of rate. And when you strip out some of the noise there, the overall trend there is pretty good. And that G&A probably grows with new units, but that's probably going to be a leverage point for them going forward. I think that G&A as a percent of sales will likely shrink for them as they look into the back half in 23. And then for EBITDA, they grew 5% quarter over quarter. The rate was about 150 basis points higher to a little under 35%. So they're above average on their EBITDA rate still. But all else equal, you look at a 5% EBITDA growth on 1% top line. That's a pretty good outcome. Now, what wasn't so good was the guidance. It previously had full year guidance that was a range of 1.3 to 1.4. They dropped that to 1.25 to 1.3, which is about a 5-point reduction at the midpoint. And they had previously assumed that have an inflection in the back half that was related to wholesale growth, I think largely in Pennsylvania and Arizona. And then they posted a negative 22% decline in second quarter wholesale. So they just, I felt that they looked at that guidance and just felt it wasn't realistic. And so, and with the new guidance range, that would imply that revenue in the back half would be somewhere between up 4% and down 4%. So, hovering somewhere around flat. And then for EBITDA growth, they guided that down from 450 to 500. They now guided that to 415 to 450, which is about a 9% reduction, and the midpoint implies that the rate fell by about 35% previously to 34 is what they're implying now. And that would also imply that your back half EBITDA would be either up 8% or down 8%. So, either somewhere slightly positive or negative, but not, hovering, somewhere around flat, probably in the back half. And so, with the back half, I think with that guidance, it implies that they assume that, things either get a little bit worse in the macro or maybe a little bit better from market conditions, but the back half for them really won't look all that different from what they did in the front half. But what will look different is the cash flow. So Truliev's cash flow in the fourth quarter and the first quarter was not great, but that was really mostly related to the harvest integration. And I think they did a good job of kind of breaking out what the impacts were in the fourth quarter and first quarter to help understand what the moving pieces were. And in the second quarter, despite being, more profitable, they had, a lot of working capital noise and cash tax payments, but, that will also likely look substantially better in the back half. Even if they did EBITDA at the bottom end of that range, they would probably generate a lot more cash in the back half of this year. And they also did do what a number of other operators did, and they reduced their CapEx spend. I think their original guidance was for like $275 in CapEx, and now they think they'll probably spend about $180 to $190 this year. So, just looking through, like, in some of these markets like Pennsylvania, do you need the biggest facility anymore? Like, probably not. So you're seeing that rational behavior where they're dialing back, some of the capital expenditures that they're making.
Yeah, I know Kim was mentioning a few times on the call that she's waiting to see how the holiday seasonality around shopping will be a leading indicator to what goes on into early 2023. So, as you're talking about it, it's something we've talked about here on the pod is in terms of guidance, in terms of estimates. Have you ever seen a consumer sector growing up, emerging in a time like what we've gone through with COVID, with this inflationary time? I mean, it just seems like we have these extraordinary circumstances that makes it very difficult to try to understand how these businesses are going to perform. But I don't know. Have you ever seen anything like it? To me, it's wild, but yeah.
No, I mean, the last time we had inflation like this in the United States was in the 80s.
Yeah.
I am not that old, but I mean, I wasn't looking at stocks in the in the 80s like that. So, but I mean, in other areas, like, in other parts of the world, I've looked at businesses like in China or in Asia where, inflation rates just tend to run structurally higher, and how, there's things you got to do to offset that, and price increases and things like that. I think with this category, it's probably a little bit more challenging in that, what I noted before, and that this is generally a deflationary category. So that just adds on an extra level of challenge when all your costs are inflating and your product costs or your pricing is going down.
Yeah. It's interesting because I think I'm always a little bit I say I'm a skeptic, but I think I'm an optimist, and hearing that people are having smaller basket sizes, but are more frequently shopping, all of those points of interaction to me are ways for these companies to build loyalty and build brands. And so I'm just seeing as an investor who also invests in technology platforms that try to create loyalty or help engage on a marketing standpoint, these are all opportunities to build new brands. And so I think this is, yes, it's probably frustrating because you have to move bodies through the store twice as often through the month if they're coming more frequently. But again, it's just one other way you can interact with the consumer to build loyalty. Shall we roll on to the double C's here?
Yeah. Why don't we do Columbia Care and Cresco together?
Yeah.
Given that they're likely to be part of the same entity here very soon. So, as you know, Cresco and Columbia Care announced that they were going to merge early this year. I think these quarters kind of highlight the strategic rationale of why that deal makes I think a lot of sense for them to come together. So, at a big picture level, Columbia Care is wide but not very deep. They got these 17 or 18 states that they're in. They got 85 dispensaries, and they have a relatively small wholesale business. It's only 16% of sales. You look at the opposite of that at Cresco, they're fairly deep, but they're not too wide. They're only in 10 states. They have 50 dispensaries, but their wholesale business is 44% of their overall revenue. They have a substantially bigger wholesale business, bigger than any other one, and substantially bigger on a dollar and a percentage basis than what Columbia Care would have. So with Columbia Care, with this very wide footprint, the challenge there is that they struggle to achieve scale in many states. Now, part of that's timing of when markets come online. Part of that's expense, related to expensive scaling in many markets. But part of that is probably that they held on to the notion that they were a medical cannabis company for too long before they began to refocus on the substantially larger adult use opportunity. And that was probably a strategic error that they made a couple of years back that probably set them back. And for Cresco, I think they have pretty good assets in the states where they operate, but they're anchored in Illinois, Pennsylvania, and Massachusetts, and pivoting into states and scaling into those states where they don't have exposure is expensive and it takes time. And they've always been more focused on the branding, and they have very established brands in their core markets, and ones that are well known and will likely become widely distributed as the cannabis industry grows and more states that convert to adult use. But the strategic focus for them on prioritizing brands, I think, has led them to some strategic M&A errors, like that purchase of Origin House that they did a few years back. And that's not really an issue anymore because they fixed the structure of that. So it's not, it's crying over spilled milk. But at this point, still, I would say that capital deployment decision, where they had this idea in their head where it's big brands are going to be key, and to have big brands, you got to be in a big state like California, and then if you can win there, you can win anywhere. I would just politely say that has not played out that way in California at all, and that strategic error set them back because they would have probably been in Florida earlier, or they would have been in other states, or they would have had that capital to deploy in these other states that are likely to be much bigger drivers of growth for them over the long term. So both of these companies had sort of strategic errors, I think, that they made that were not fatal by any means, but it certainly, I think, set them back. And this is one way that they can sort of correct both of those issues that they had several years back by merging this together. And so, I think the point there is that original strategy of being a wide medical operator and Cresco's focus on brands put them in a position where they're better off together than they are alone. Where Cresco has these kind of big brands, and Columbia Care has these big lands, if you will, and they put these big brands in the big lands or whatever, and then they hopefully have a happier long-term outcome. But over the near term, it's challenging to see how these companies would be able to profitably grow more into next year given some of these issues. Now, to tie that back in the quarter, maybe talk about Columbia Care first. Columbia Care, this wasn't a particularly good quarter for them, but it's a quarter that reflects a prior attempt to gain operating scale on a very wide asset base, and basically until all these other assets on the East Coast are converted to adult use. So in 2020 and 2021, an easy and less expensive way for them to gain scale was to go big in Colorado or to go big in California. So they bought TGS, and they later bought Medicine Man. They also pursued a smaller, but probably not too dissimilar strategy in California, where they bought Project Cannabis and some other assets. But the idea was basically you buy these established businesses in Colorado that probably run at a 20% EBITDA rate, because they would give them over $100 million in revenue that would run through the state, that would boost their overall operating profitability and provide immediate leverage on all that corporate overhead required to run brands and grows and retail across all these states. But by late 2020 and early 2021, they were running at a 5% EBITDA margin, probably. So it was a little weak for them out of the gate. So California and Colorado were tough from the get-go. But by late last year or middle of last year, these East Coast markets are growing. Colorado was starting to do what it intended, and their margins went from 5% up to 17%. But what happened in 2022 is that California and Colorado went from margin rates that probably weren't all that impressive to being a big drag because the markets changed very rapidly on them. And they moved from being, likely that were tailwinds or helping them to cover these fixed costs to being states that are substantial margin drags. So even as these East Coast states were growing, what happened in the West basically negated all the profit growth that they had from all these East Coast markets. So on the revenue side for them, their revenue grew 5% quarter over quarter, and that was mostly New Jersey, Virginia, and West Virginia. The consensus thought that they would grow around 15%, and they only grew about 5% in the quarter. And that was largely driven by what happened in Colorado and California. That was a sizable offset to all the good stuff that they had going on in New Jersey, Virginia, and West Virginia. And their retail revenue was up, driven by those states, around 4%. And their wholesale revenue actually grew 11% on PA and West Virginia. But again, that's a pretty small, probably fairly unique thing that we saw that happened with them in the quarter, where they were actually able to grow that. But the margins had a pretty substantial step down. Their adjusted gross margin rate declined by about 350 basis points to 42.5, which is a good 5 to 6 points below peers. And their implied OPEX spend also moved in the wrong direction by about 90 bips. So their overall EBITDA rate declined by about 440 basis points to 9.3%. Now, the average of the top MSOs, like I said before, they're doing like 25s and 30s. So these guys are at 9.3. And with that 4.5 point in EBITDA rate, their dollars fell by almost by a third to $12 million, where about 6 million of that was driven by Colorado. So consensus thought they would do like 22, and they actually did 12. And a lot of that was Colorado, but it was a substantial miss on profitability. And to be fair to them, they did note that if you stripped out, Colorado and California, the margins would have been about 5 points higher. But even at a 14% EBITDA margin, they're still a good 10 points below peers in terms of what they have here. If margins aren't looking good, if the revenue ain't looking so hot, from a cash flow perspective, not particularly a good story either. They did have the cash tax expense that was quite high, and they did spend a lot on CapEx, which will drop off substantially. So we'll probably see an improvement here. But when they provided their guidance, they think that they'll only get to a mid-single digit percentage top line growth in both the third and then again in the fourth quarter. And off the first half EBITDA rate that they had, which was around 11%, they think they'll only get about 150 to 250 basis points of margin expansion in the third quarter and then again in the fourth quarter. So if you tie that into their prior guidance, they started the year thinking they would do 625 to 675 in revenue. But if you assume 5% growth in the third and then again in the fourth, that looks more like 530. So 530 versus 625 to 675 is a pretty big, difference there. And on a percentage basis, they thought they would be doing something like 30% growth, and now it's more like 12% growth. And on an EBITDA basis, they'll probably do, their guide implies they'll probably do like 70 million in EBITDA versus the 125 to 135 they guided earlier in the year. Now, yeah, there were macro factors that impacted everyone, and new market growth is often slower than they assume. But Colorado and California were really substantial drags on growth for them. But to tie that back to the big picture here, this quarter reflects the strategic rationale, again, why this makes sense. And to step back and think about like the way that Columbia Care describes their states, they are EBITDA positive in 15 out of the 17 states that they operate in. But even with 15 states being EBITDA positive, they're only generating a 9% EBITDA margin. And that's indicative of two things here. One is that a lack of scale in the states where it operates, or where they have limited scale in perhaps some states that's being masked by more scale in other states, or that it's a substantial offset. And the second is that they're likely overburdened by corporate overhead, which is probably 15 to 20% of total sales. So this company, when you look at it from an operating margin standpoint, it's really geared to have revenue that's probably 2 times higher than what they're doing. And with their SG&A being at like 50% of sales, and with 280E, and all that not being tax deductible, it just sets up a pretty bad picture for cash flow generation and how you actually grow the business. Now, to be very fair, like none of these challenges are insurmountable. And if this merger didn't happen, I think that some of these issues could be fixed, but it creates a lot of, you need a lot of inflection. Let me just put it that way. There's a lot of things that have to happen right with this business to kind of get it on the right path. And as a combined entity, this would drastically alter the growth profile for both of these companies and substantially eliminate a lot of that duplication in G&A and production in some of these states. And if it lifts the revenue and it lifts the margin rate over time, the cash flow generation for the combined company would likely be far superior than what it would be for these individual operators. That deal is still on track. It likely closed in the fourth quarter. They're still making progress on it. I think by the end of September, they'll tell us what the assets are that they're selling and what the proceeds are from it. I think they originally talked about when they announced the deal that the proceeds would probably be between 250 and 500. And they confirmed that, they probably at the lower end of that range, but probably north of 300 million in proceeds. And that'll be, that those cash proceeds will be critical to fund CapEx and pay down debt. But, this is a pretty big and complex deal. We still have to get the regulatory approvals that should happen by the fourth quarter. But, sometimes you just don't know what happens with some of these states, and, it could potentially slip. But I mean, everything seems to be on track. But into 2023, there's going to be, a substantial amount of integration that will have to be done on these two businesses. And I'm guessing that, if it took, truly the good 2 quarters, and I think they did it pretty well to integrate Harvest, like this is one that'll probably take a year to get fully consolidated.
Next year, we'll see something out of that.
Hopefully long before then. But yeah, my point is like there's a lot of, when you have these big deals that kind of get together, it out of the gate, like it doesn't look anything like it's going to look over the long term. And you have to do a lot of substantial integration work to get the systems and people and all that kind of in place to run the business on a go forward. So that takes time, and that will, like I said, probably take optimistically 6 months on the low end, and probably, I'm guessing, like a year to fully get this, to a point where like this is the new Cresco.
I do think these two are going to make each other better by coming together. Like, I really think that I like Columbia Care's retail strategy. I like their digital strategies. And I think that, obviously Cresco has the massive back end to power that. And so I think it could be a really interesting combination when you pull it together. I'm so curious to see what happens with the divestiture of the different assets across the markets. So I think it's coming in a couple of weeks. So looking forward to that.
For Cresco, I mean, for the quarter itself, I could keep this pretty short because the punchline is that Cresco doesn't have New Jersey exposure. They didn't really have much top line growth, which, but I think they managed the business pretty well in the quarter. Overall revenue for them was only up about 2%. 3% of that was retail growth, and their wholesale was flat. Now, retail would have had that same recovery that we noted, across a lot of the markets that probably lifted their revenue there a little bit. But I mean, wholesale prices in Cresco's markets were down like probably between 10 and 30%. And the wholesale revenue for them was flat. So, wholesale revenue for them is like 44% of sales. They have the highest mix. And despite that price compression, they were able to keep their wholesale revenue flat in the quarter. And they were able to get their gross margin rate up by about 40 bips in the quarter to 53% on production efficiency gains and Florida growth. Their core G&A dollars grew at basically the rate of sales. So their rate overall was flattish. Their EBITDA dollars were basically flat, and rate went down a little bit. But, overall, they had the big cash tax payments and cash flow was weak. But, similar trend, I'm probably saying across all these companies, the back half, the CapEx drops off, tax payments will be lower, they'll have less working capital, and therefore cash flow likely improves. If the next 2 quarters look a lot like this one, where there's a lot happening in the background, but nothing moves, that would probably be a win. But they do have some retail addition in Florida. They do have a few projects that are coming online that could happen, that could help back half revenue. But I don't see this really growing substantially into the back half. If they can sustain margin rates at around 23% in the back half, that's a little bit below average, but that's a win. The risk into the back half for them is the same with everyone, is that, if soft consumer spending begins to become more prevalent and we see a bigger step back in consumer spending, that would, obviously hurt them. But this company, given that they do have this bigger wholesale business, if those MSOs do prioritize internal brand sales ahead of their own brands, that could hurt their wholesale business. Everyone with a wholesale business has that risk to a degree, but, like I said, just because they're bigger there, the risk is bigger for them. But this is a quarter for Cresco. I mean, it was like really not a whole lot of movement, but I think it was really an excellent quarter because despite, not having a ton of top line growth and having all these pressures, they basically were able to keep their margin rates flat, which I think, is all else equal a win.
Yeah, lots there. So we've hit GTI, Curaleaf, Trulieve, Cresco, Columbia Care. Who's next on the list?
So Verano revenue was up 11% quarter over quarter. The EBITDA dollars dropped 13% though, with rate dropping around 9 points, which is a pretty substantial decline on headcount investment. Now their retail segment was up 13%. It was driven by, as you can expect, New Jersey and a little bit of Florida, but their wholesale program was up around 1% on Illinois and New Jersey. And that was likely offset, with price decline as we noted with the others. But we expect New Jersey to really be a big top line driver for Verano really in the back half. Now their gross margins were down a little bit on headcount addition and cultivation, and they were likely hurt by price decline, which was probably offset a little bit by what happened in New Jersey. But in the G&A side, they've been investing and will continue to invest in headcount, which is growing the G&A dollars, and that's really becoming a pretty big headwind to EBITDA for them. So they had 11% sales growth, as I noted, but their margin rates plunged by 9 points to 34%. And for the outlook, the company revised the expectation that they would likely be able to sustain an EBITDA rate over 40% this year to something below that. So they'll probably be in the high 30s, but they did lower the expectation for margins as they invest more in G&A, and that will hurt the overall profitability. Now the company is still very good at generating cash flow, and although margin decline and that drop in profit dollars will hurt that, but even with the big cash tax payment, they had good cash flow generation in the front half of the year. One other thing to watch with this company is that they have a $350 million credit facility with two maturities in mid 23 that they'll probably work on getting refinanced. I think in the quarterly report they just filed today, they said they're working on that at present. So I assume we'll probably have something there in the fall, or maybe after Labor Day, will they'll refi that. And then their CapEx budget was dropped in the back half, and they do have a little bit of deferred consideration. They're lighter on the cash balances, so when you look at the CapEx and look at the deferred consideration, it looks tight, but they generate cash flow in the back half, and so they're very likely to not have any issues with that.
Yeah, that's when I'm going to be watching on those maturities and how they manage to restructure that or renegotiate it.
And then they're in the process of doing these restatements now. I haven't really gone through all of them, but they're definitely working on improving the quality of their financial reporting.
Yeah. I mean, talk about a massive combination before they went public. And so I think they were moving fast. So we'll see hopefully it'll start being more consistent. Yeah.
They have been a publicly traded company since since February of 2021, and they have not filed a single quarterly financial statement that they didn't have to restate twice, and they're restating their annual report too. So, I mean, they really have best in class operating metrics for an MSO, but their financial reporting, it ain't there yet. That needs to be a core competency for a publicly traded company, and that's really just the basics of blocking and tackling. So they're getting that in place. But I mean, they have a new CFO that they added on at the beginning of the year, and he seems to have the capacity and experience to I think address some of these issues. But bottom line, restatements, I guess, the fact that they found the errors, it's reflective of identifying the problem and I'm sure the path to fixing it. But if your operating metrics even if you have best in class operating metrics, if the financial reporting is garbage, investors don't generally have confidence in it. So that's something that we look forward to them improving over this quarter, next quarter, and every quarter in the future.
And on, yeah, agree. All right, shall we power through Ascend and Air just to wrap it up?
Sure. Yep. I mean, Ascend, I think Air is pretty simple. Ascend, I think AWH has a very narrow footprint. They're anchored in Illinois. I think 80% of their revenue last year came from Illinois. They're vertically integrated in Massachusetts, in Michigan, and New Jersey. Their last two quarter results were similar to what we heard from other operators, where they had revenue decline and margin decline from the macro pressures, inflation, and all that going on. This quarter kind of fully reversed that soft top line trend and made up for most of that margin that was lost in the last two quarters. For them, overall revenue was up 15%, which was about double the rate that consensus had assumed. So they had a pretty big beat. Retail revenue was up 19%. That was primarily driven by the adult use dispensary that they had in Rochelle Park, which is doing quite well. But Michigan retail, which is actually did quite well for them, which I very, very rarely hear. Michigan's going really well. They had a pretty good quarter in Michigan on just, I guess, better execution in the state, but they also had partial contribution from a new store. But that existing retail base that they had positive comps, which is like I said, that's kudos to them because I don't really hear many good things coming out of Michigan. Their net wholesale business grew a little bit under 1%, so basically flat. And as a percentage of revenue, obviously that dropped off a little bit. They will likely get more growth from that into 23 as they roll out their bigger New Jersey facility. But Illinois for them is critical. You may get a little bit of growth in that wholesale business from the additional dispensaries that'll be added there over the course of the next couple of quarters. But it's probably more of a 2023 scenario. But their gross margin grew by about 270 basis points to around 46%. That was primarily on New Jersey. And they're also selling more product through their own stores, which is, definitely a margin benefit for them. The EBITDA growth was substantially better than expected. So consensus assumed that they would be up about 10% quarter over quarter, and they actually grew 28% quarter over quarter, and rate improved by a little over 2 points to 21%. Still had negative cash flow from ops. Won't walk it through, but probably that improves in the back half, as it will with everyone. They will likely still make a cash payment in the fourth quarter, which may keep their cash flow from ops negative in the fourth quarter. And there are a few that would potentially have that as Ascend will, but I mean, directionally, the cash flow for them, I think, is moving in the right direction. And the M&A, they announced they were going to acquire a couple more dispensaries in Illinois that will get them to the cap. And then the other state, where else did they do? They did Ohio, I believe, was the other one. And then they walked away from this long-running saga with MedMen's assets in New York, where that deal was just taking forever and a day to get done, and the asset quality wasn't there, and the regulatory picture, frankly, isn't all that clear for New York at this point. So probably just made sense to walk away from that and bank the $70 million and put it into other markets than it would be to hope that you can get those assets operational and up and ready, and for a market that we have, like I said, not a great deal of visibility on when that will actually be turned on, or how it will look when it does turn on.
All right, so air.
Make air quick because we've been going on for a long time.
I know. You're a machine. This is amazing. Yeah.
So air would be like frankly, air was kind of like Cresco. There's like not a lot of movement, or no, actually, let me take that back. There was a lot of movement, but financially, like not a whole lot moved within their P&L on the quarter. The revenue was flat. Gross margin was basically flat. EBITDA dollars were basically flat. They got a little sliver of growth from very late in the quarter. They had these New Jersey dispensaries that opened up, and that clearly helped to offset pressure that they were feeling in Nevada and Massachusetts. Their retail growth was 1%. Their wholesale revenue declined around 11%. Now they don't also have a very big wholesale business. It's around 15% of sales. That was probably down mostly on Massachusetts, which is where they have the majority of their wholesale revenue. But like I said, retail was driving most of that growth. They had roughly outlined a framework this year in terms of their expectations, which was things would be flat in the front half, and man, were they flat. They were really flat on revenue, and operating metrics didn't change too much, but they always expected this step function change in the back half. Now, they affirmed that outlook of that step function change, but they only think that step function is going to be around 10% of a step up in revenue and EBITDA into the third quarter. And then by the fourth quarter, they expect to have another more substantial step up in revenue and more substantial margin improvement. But I'm guessing that probably looks like $150 million in revenue in the fourth quarter, and they probably have an EBITDA rate that's probably in the low 20s. Now, they had originally thought that would probably be like $200 million versus probably the 150 I think they'll do now, and they thought that margin rate would be well over 30%. It's probably going to be like in the low 20s. So to be fair on what's going on here, there's all sorts of timing issues and then issues related to assets and regulatory approvals that has reduced, I think, expectations for this company pretty substantially over the course of this year. 100% still impacted estimates for the front half, but the asset base here is largely complete. I mean, they're wrapping up a lot of their capital projects. Most of this stuff is coming online. They still have more stuff in the back half, but at this point, it's about execution. So if this company could be a 20% MSO, where they could knock it out of the park and they could make this a 30% plus kind of MSO and put them at the level that they were at a couple of years ago. But at this point, like I said, the assets are in place. It's about execution. I have confidence that they're going to be able to execute, but it's really up to them to make sure that this is a strong MSO into 23. And I'm hoping that they can get those margins up.
I am too. I mean, I'm excited for some of their new locations, especially in Massachusetts. I mean, I know wholesaling in Massachusetts, I don't think one operator has been happy with how that's gone for them. And I think they felt it acutely, but we'll see what happens next. But I do think some of those new locations are really great to see turning on. But yeah, I was a little sad to see the estimates coming down for the back half of the year, but I'd rather that groups start getting tighter on that and then hitting. So
yeah,
I'm into that. Yeah.
Well, fantastic.
Yeah, me
Matt.
too.
You want to be raising estimates, not lowering them.
Exactly.
But I think, I think that the one challenge we did have this year is that the estimates were just too high going into the year, because the way you model this is sort of sequentially. You had a very weak start to the year, and then then some of these markets did not grow at the same pace. You had these issues on the West Coast. You had the overarching macro. I think the position that most people should take into next year is a lot of these markets aren't going to grow, right? So, take the position that if you have a scaled operation in an existing state, why would that, grow unless there's some structural change to the market? So, I think with that in mind, that's the way that these companies should probably be modeled into next year. And I don't know how much more estimates need to come down, but I feel like there's probably more, there's probably better estimates right now going into 23, or I hope people have estimated those estimates into 23. They're in a more realistic spot right now going into 23 than they were at this point in 21 going into 22.
Yeah, I happen to agree with you. Well, thank you for that incredible rundown. I had heard from some people that they listened to your quarterly podcast with us twice to make sure that they're capturing all of the good information. So I can't say enough about it. So thank you so much for this. We're glad to have you in the industry.
Yeah, that was fantastic. Green Thumb, Curaleaf, True Leaf, Cresco, Columbia Care, Verano, Ascend, and Air, all in one show. Yeah, power session for sure. Yeah. Well, we're recording this on Friday, August 19th, and I want to give a quick shout out to friend of the show and the other half of Poseidon, Morgan Paxia, on his birthday. So happy birthday, Morgan. And Matt, we can't thank you enough. We always get the best feedback on this show. It always drives a ton of downloads. I think your insights are just unparalleled in a lot of ways. So really appreciate you coming on again, and looking forward to having you again next quarter and continuing to follow these stories through. And I know as we wrap up here that you have to share some disclaimers. So I'm going to give you a minute to throw those out there.
Yep. Needham & Company is an investment bank that generates revenue from investment banking services and may act as a market maker in companies mentioned today. Needham does not own any position over 1% in any of these companies, and I do not own, or nor does any member of my family have a financial interest in any of the companies that we spoke about today.
There it is.
Well done.
There it is.
Well done. Do you have that memorized yet?
Yeah,
Not
I
yet.
don't want to memorize a compliance.
Don't
memorizing compliance disclosures. I don't have so many brain cells out there that I can.
Don't let that take rent in your brain. Yeah.
There you go.
Exactly.
All right. Well, we'll see you. I'll see you in Benzinga at Benzinga in Chicago. Yeah.
Yep.
Yep.
Be there.
And I hopefully have you on for the next Q.
Great. Sounds good.
Thank you.
All right, guys. Talk soon.
Thanks.
Have a good one.
Thanks for listening to the High Rise Podcast, presented by Headset. For more information on Headset, visit headset.io.